Hello everyone, investment scams rampant. Please vigilant and discerning. Do not trust information from unknown sources. Please make sure recognize two official Capital Securities community, Facebook, Capital Securities, YouTube, Capital Wealth Insights.
Hello everyone, welcome to Quinny Good Night. Today is Tuesday, November 25th. I'm analyst Jiang Ji. At this time, please remember to like, subscribe, and share for us. If you have any investment questions, feel free to leave me a message. If I don't get to answer your question today, I'll make sure to follow up and address it in tomorrow's class. Hello again, everyone. There are a lot of economic data releases today. After the US government reopened, many of the previously delayed data will be released tonight and tomorrow, so everyone should really pay attention to the relevant economic data. All right, let's see. Good evening to Mei Daizi, hello to Hui Junjuan, also to Yu Lan, Yue Gai, Yue Li, Fei Deyu, and good night to everyone else as well. Okay, great. Now let's get into today's main investment highlights. Let's take a look. First, aside from some economic data today, I'll also give you some updates on international events, both big and small. First up, 2 more medals for the singing. Trump is paving the way for his election campaign. Who are the singing doves? They're the dovish members. Today, before the Federal Reserve's monetary policy meeting, they're entering the blackout period. 2 more dovish members joined today. Can these 2 actually impact monetary policy? I'll tell you exactly who they are. In addition, Trump is also making moves for the election. We know that next year's midterm elections will see the Republicans and Democrats facing off. And of course, this is all about trying to roll out more and more economic incentives to win over voters. Naturally, Trump isn't holding back either. Today, Trump also laid out some plans related to the election. So when it comes to issues like inflation, essential goods, and other economic data and support, what exactly has Trump done to pave the way? Today, I'll also give you an update on that. Of course, all these actions he's taking, including, for example, the reports today that Trump might have a phone call with Xi Jinping, are really just part of paving the way for next year's election. On the economic and industry side, people are also keeping an eye on whether the profits of the Magnificent Seven have peaked. Right now, the market is more concerned that the stock prices of these leading companies are at relatively high levels. And with the AI Capital Index continuing to expand, there's also worry about whether this so-called AI perpetual motion machine might turn into a bubble. This is a key point of concern and doubt in the market. From Meta to Oracle and the rest, the real question is whether with these increases or approvals in capital expenditures, they can actually generate more positive cash flow. That's another thing the market is concerned about. So after all the earnings reports from the leading companies for the third quarter have been released one after another, including the outlook for the fourth quarter, in addition to the third quarter earnings, the key question is whether profits will really be as expected. I'll explain that clearly to everyone today. Also, AI has actually started to form alliances and partnerships. So which are the 3 most famous major AI companies in the world? But there's OpenAI's ChatGPT then, Google's Gemini, and the Claude platform. These 3 companies are making a lot of noise as they roll out their strategies in the AI market. However, they're gradually realizing that they need to keep forming strategic alliances with many other big companies. Sometimes former competitors might become friends, and former friends might turn into bitter rivals. So as these AI alliances start to form, which companies should you be paying attention to? If you pick the right side, stock prices could skyrocket. But if you pick the wrong side, in today's pre-market session, some AI companies actually saw a sharp drop. What exactly went wrong? So after the show, I'll explain the economic data and all these international happenings to everyone. Good evening, everyone. Good evening to Em. Good evening to Dingyan, and also to me. I love Joplin. Good evening to Banana Shang. Good evening to you too, and good night, everyone. All right, let's take a look. Tonight at 9:30, there's an important US retail sales report for September. It's worth noting because the previous value was 0.6% and the forecast is slightly lower at 0.4%. Keep an eye on this. Here's how it works with the US GDP. About 70% of the US GDP comes from consumer spending. And within that consumer spending, what makes up 40%? It's retail sales. The other 60% comes from things like service sales. So retail sales make up 40% of consumer spending. And as I just mentioned, consumer spending accounts for 70% of GDP. So if you multiply those together, retail sales alone make up nearly 30% of the US GDP. So its magnitude, whether it's high or low, has a significant impact on GDP. If retail sales perform well, then there really isn't much doubt about US GDP growth. That's why whenever we talk about monthly retail sales, the market sometimes jokingly calls it the scary data. This is because retail sales actually have a huge impact on the overall US economy, its strength or weakness, and on GDP. So at 9:30, we'll take a look together at the changes between the previous value and the expected value. Also, at the same time, the US September PPI monthly and yearly rates will be released. To give you a preview of the monthly rate, the previous value was negative 0.1. The expected value is projected to rise slightly to 0.3%. For the yearly rate, the previous value was 2.6%, and the expectation is 2.7%. Excluding energy and food, the core PPI monthly and yearly rates are: previous monthly rate was negative 0.1, and the expected value is set to rise slightly to 0.2%. For the annual figures, the previous value was 2.8%, and the expectation is 2.7%. These will be released around 9:30 in the evening and are important. Whether it's PPI, CPI, or the upcoming PCE data possibly released December 5th, they all matter. These data are closely related to inflation. If the data released later is about the same as the expected value, or even lower than the previous value or the forecast, it means that inflation is not out of control. If inflation data is not out of control and doesn't spike, then the Fed will have a stronger case to cut interest rates in December or even next year. So later on, we can observe the changes between the expected values and the previous figures, as well as the monthly retail sales rate. All right, for basic orders, who guarantees them? Happy, hello. The 8 major institutional investors bought over $50 billion in the past week. For net buying, I haven't really paid attention to them lately. Sometimes if I have time, I'll look. If not, I just check Taiwan stocks occasionally. If, as you said, the 8 major institutional investors net bought over $50 billion in a week, it's clear there are a lot of funds supporting the market, especially Taiwan stocks. The National Stabilization Fund hasn't exited its positions yet. They haven't exited. So if the National Stabilization Fund hasn't exited the market, to some extent, it's also a way to, let's put it this way. Everyone knows that besides the US-China trade war, companies in Taiwan, the US, Korea, and Japan, as well as those in Southeast and Northeast Asia, are all negotiating with the US, right? As these negotiations continue, Japan and Korea are facing about a 15% tariff. But in addition to the 15% tariff, they also have to pay extra. Like Japan, I think it's about $550 billion, right? And Korea has to make an additional investment of about $350 billion in the US. For Taiwan, what's the percentage? Taiwan's tariff rate is higher than Korea and Japan, about 20%. But based on current public information, Taiwan hasn't made extra US investments like $200 or $300 billion. The future is uncertain. We don't know the exact impact yet. Looking at current numbers with a 15% versus 20% tariff, Taiwan is at a competitive disadvantage. Still, our competitiveness is strong, especially in semiconductors, our silicon shield, and in electronics. We're very strong. Regarding the National Stabilization Fund, whether it's about how much the 8 major banks are buying, how they're buying, or how the fund is supporting the market, for now, it seems someone powerful is backing us. We can only say that. For now, someone is still looking out for us. That's all. As for the Taiwan stock market, if we have time, we'll update everyone later. Now, aside from the economic data at 9:30, another set of economic data comes out after 10 p.m., but it's neutral. For example, the FHFA House Price Index for September was 0.4%, forecasted at 0.2%. This relates to real estate, but its overall importance is low. In addition, the S&P Case-Shiller 20-City Home Price Year-over-Year Index is similar. The previous value was 1.58%, and the forecast is 1.4%. This is also released at 10 p.m. As for the last few data points, at 11 p.m., there's the U.S. August Business Inventories month-over-month figure. But since this is for August, it's already quite outdated. So for the data released at 10 and 11 p.m., you can just use them as a reference, since they're from quite a while ago. The previous value was 0.2%, and the forecast is 0.1%. As for the October pending home sales month-over-month, the previous value was 0%, and the forecast is 0.5%. Finally, there are a few more data points, but these are becoming less and less important. For example, the November Conference Board Consumer Confidence Index will be released at 11 p.m. The previous value was 94.6, and the forecast is 93.4. The Richmond Fed Manufacturing Index will also be released at 11 p.m., with the previous value at -4 and the forecast at -5. So as you can see, starting from the retail sales MOM and PPI, and then later at 11 p.m. with the Richmond data, there are about 8 or 9 data releases tonight. But are all of them equally important? No, some of the data might be from a long time ago, and some data may not have much impact on the market. Some of them don't really move the market much. The important ones are at 9:30 tonight, so we should pay attention then. At 9:30 p.m., retail sales and PPI will be more significant. Alice Fu, good evening. Who is this? Stanley6314, good night. If you have time, great. Welcome to the class. If you have a way to listen to this live stream, just join in. Everyone can interact and discuss the market together in the chat. If you can't make it in time, that's okay too. Just watch the replay. I always watch my own replays or other teachers' replays because time is limited. Even when I watch my own replays, I fast forward, usually at 1.5 times or 2 times speed. That's how I watch them. Sometimes I check to see if I missed any information or details, so I go back and watch myself. All right, so let's take a look. Besides the economic data, which we'll go over together in a bit, there are also statements from Federal Reserve officials. Why do I say that today 2 more dovish members have been added? For example, yesterday, Williams' voting position was quite well known. Then there are people like Waller, Lisa, Bowman, and even Milan, who are all considered more dovish. There are also other officials, some with voting rights and some without. Some of them, like Logan and Daly, have opinions that aren't as divided between hawkish and dovish. Today, I also want to add a bit more about Waller. Of course, Waller is also considered more dovish. Why is Waller seen as dovish? It's simple. Just remember a few names. Among the Federal Reserve Board members, there's Waller, Millen, and Bowman. These few, especially Waller and Bowman, are already considered candidates for next year's, well, we don't even have to say next year, for the next Federal Reserve chair. These are the main ones. Waller, or as we sometimes call him, Whoa-Whoa, just Waller and Wash. Hassett and even Bowman are on the list of candidates. If you remember clearly, Treasury Secretary Besson once told everyone that he planned to provide Trump with the main 5 candidates before Christmas this year, about 4 or 5 people. The list should be announced before Christmas, so everyone can keep an eye out and see, around Christmas, just who will be the Federal Reserve's Santa Claus next year. The candidates are basically just these 4 or 5 people. Waller's one of them, as well as former Vice Chair Lishwash and current economic advisor Hassett. They're all on the candidate list. Of course, since Waller is a candidate, he is definitely more dovish. What did he say? He said that there hasn't been much change in the current economic data. Inflation isn't the biggest problem. What he's worried about is that the labor market might not do so well. His stance is the same. Look at a possible rate cut in December. Then there's this committee member named Daly. Daly isn't a voting member this year, but we still need to take his opinion into account. He said the job market could suddenly deteriorate. I mean, the word suddenly is pretty scary. No one really knows why it would suddenly get worse, but anyway, he said it could suddenly deteriorate. Maybe that's just how it is. Whether it's the US-China trade war or countries imposing tariffs on each other, or maybe prices suddenly surging due to inflation, or a lot of people getting laid off, whatever the reason, he said the job market could suddenly deteriorate. So he supports a rate cut in December. So looking at it now, among the dovish and hawkish members of the Fed, today with these 2 more people voicing dovish arguments, I think the dovish side now slightly exceeds 50%. It's probably around 55 to 60%. But if you ask whether it'll be 100% dovish, it doesn't look like that's the case right now. It's not. On another note, the investment from Goldman Sachs said that they expect the Fed to basically cut rates by a 1/4 point in December. That's pretty much a given. They even predict that by 2026, the overall interest rate level will drop from where it is now. Right now, it's at 3.75% to 4%. All right, so from the 3.75% to 4% range, it will drop to 3% to 3.25%. In other words, Goldman Sachs predicts that the Fed could cut rates by nearly 3/4 of a point next year, which is about 0.75%. So basically, everyone should know that rate cuts are generally good for the economy and good for the stock market. As long as you have this basic idea, that's enough. So as for whether there will be another rate cut this December, well, in my opinion, honestly, the impact or shock wouldn't be all that significant. But if rate cuts can continue next year, it would definitely be a plus for both the stock market and the economy. This is also something Trump would be happy to see, because don't forget, next year is the midterm election. Actually, whether it's the Republicans or the Democrats, both sides want to offer real benefits to attract the public. There are several ways to gain public support. If the economy and stock market are strong, that's the easiest. For example, if the Taiwan stock market rises to 28,000 points and in the future reaches 30,000, you might think this government is doing well, Taiwan's economy is strong, and the administration is performing well. Maybe you'll get that kind of feeling, right? So actually, it's the same in every country. In every country, whenever it's an election year, usually the stock market doesn't perform too badly during that year. Because if the stock market does really poorly, the ruling party basically doesn't even need to bother running. That's usually the idea, right? So will there be a rate cut in December? Good evening to everyone watching from abroad. Will there be another rate cut in December? I think, or rather we think, there's a chance, but right now it's about 50-50. As for whether there really will be a rate cut, there's still almost half a month left before December 11th. In this half month, let's just keep an eye on the economic data. These data will directly affect whether there will be another rate cut in mid-December. For example, tonight at 9:30, the retail sales monthly rate and the PPI are both relatively important because one reflects inflation and the other reflects the state of the economy. Retail sales as an indicator of economic conditions is also a major reference point for the Federal Reserve when making monetary policy adjustments. So the results will be announced at 9:30. Good night to the staff. Good night to everyone working. In addition, several investment institutions are added again. Every year as we approach the end of the year, whether it's Taiwanese investment institutions or foreign ones, they all start doing the same thing. They begin forecasting next year's market index points. As for these forecasts of next year's market index points, how reliable are they? That's really up to each person's judgment. Sometimes when the market is doing well, investment institutions keep raising their target prices. But when the market is doing poorly, like this year isn't good, or things aren't looking good at year end, then what about next year? They predict next year's index points will be even worse. It's not exactly offering help when it's most needed. It's more like either gilding the lily or kicking someone when they're down. These forecasts tend to lean toward one of those situations. So for example, today we saw maybe the chief strategist Michael Wilson saying that right now US stocks are facing short-term pressure, but investors can take advantage of the recent pullback as an opportunity to position themselves for next year. Looking at the S&P for next year, they're projecting 7,800 points. Right now, the S&P is at about how many points? Over 6,000, right? Somewhere between 6,200 and 6,500. So there's still a way to go. But when they say it'll reach 7,800 next year, honestly, no institution will guarantee exactly when it'll hit 7,800. They'll say, we have to look at current EPS, current PE ratio, maybe estimate how earnings reports look now, what's happening with the Magnificent Seven, and maybe what the future S&P index could do. They'll use a PE ratio of 20, 25, or whatever the historical average is. They'll have a model for it. They have a model to estimate next year the economy looks good, earnings are solid, and AI development is progressing, so the S&P index could reach 7,800 points. Of course, whether that happens in January, February, March, December, or another month, nobody knows exactly when. No one knows if it will happen. What they do is provide a data point so people can see if their outlook is more bullish or conservative. When you look at these numbers, the actual number isn't that important. In my view, the specific number has never really mattered. You just need to see if their estimate is higher or lower than the current one, and that's enough. In other words, just look at these investment institutions and their models. Whether forecasts are optimistic or conservative, as long as you understand them, that's enough. For example, Morgan Stanley estimates 7,800 points. Deutsche Bank is more optimistic at 8,000, HSBC sees 7,500, Barclays projects 7,400, UBS forecasts 7,700, and some go as high as 8,400. Basically, it's all over the place. It depends on how loudly you want to call it. It's like vendors shouting prices at a night market. Some say 7,008, 7,005, 8,000. Some even go as high as 8,500. Strange no one calls for 10,000 points yet. Maybe if the S&P rises to 8,000 next year, some firm will call for 10,000. It's the same game. So overall, I think the actual numbers aren't that important. Just set them aside. What you can see from these investment firms is that they're basically telling everyone that, as things stand, they're still bullish for next year, and that's enough. As for whether the market will start high and go low, start low and go high, or start low and keep going higher, I don't think you need to worry too much about that. After all, there are a lot of economic data points we need to keep tracking. There are also international factors like Trump's statements, the trade war between China and the US, and the interactions between different countries. Even the so-called US midterm elections coming up in mid-November next year. There are just so many variables. So honestly, these numbers, no one can predict the estimates with certainty, but it's pretty clear that next year's market shouldn't be too bad. Why? The biggest reason, in my opinion, is because of the elections next year. That's basically the idea. Also, regarding the China-US trade war and international trade disputes between countries, it feels like there might be a truce for a year. Why a truce? Because Trump will be focusing all his efforts on the election. As for the US Bureau of Economic Analysis, they said the September PCE will be released on December 5th, so we'll just have to wait for the PCE data to come out on December 5th. The core PCE data is even more important. Core PCE is usually a key inflation indicator that the Federal Reserve relies on when making monetary policy decisions. It might even be more important than CPI or PPI. So if the PCE data is released on December 5th, no matter whether it's high or low, it will have an even greater impact on the Federal Reserve's interest rate decision on December 11th. So everyone should pay a bit of attention on December 5th, because December 5th is basically next Friday. Next Friday, just keep an eye on the release of the PCE data. In addition, as I mentioned, Trump is currently paving the way for the election. What exactly is he paving? Actually, he's already gradually making arrangements. Besides reaching in to influence the dovish members of the Federal Reserve and their dovish positioning, there's also the matter of the Fed chair next May, whether the chair will step down, the arrangements for the chair position, or the placement of other members. He's been taking action on all of this. If these placements are handled well, then next year the Fed's monetary policy will basically remain dovish and continue moving toward rate cuts, which would benefit the economy. Besides getting involved with the Fed, today he basically proposed two things. First, he plans to extend the expiring Obamacare subsidy program for another 2 years next month. Simply put, Obamacare subsidies are kind of like, you can imagine, when you go see a doctor. Well, it's not exactly like Taiwan's national health insurance, but it's a similar idea. If there are subsidies for health insurance, or if lower-income people get some medical assistance, then the financial and economic pressure on people's daily lives is lower. So by extending the subsidy for another 2 years, in a way, I think he's also trying to appeal to those who are more concerned about the economy. It's about gaining favor and poll support from lower and middle classes. Extending the subsidy is mainly for polls for next year's election. He also mentioned a call with Xi Jinping. They discussed Taiwan, China-US trade, AI regulations, and other topics. So what he's trying to show is a vision. What kind of vision? It's to tell everyone that he wants to have good talks with China right now and not be confrontational. That's the message he wants to convey. It's like saying, we're making progress and we're having discussions on all fronts. He even mentioned that he has accepted an invitation and will visit Beijing in April next year. In other words, it's pretty clear that the US-China trade war, or competition, at least to some extent before next year's election, is unlikely to escalate. It's not likely to heat up. Just remember that. As long as it doesn't escalate, it means that the economy, people's livelihoods, or even things like corporate revenue and profits, and even inflation, won't head in a really bad direction. If things don't go badly, what does that mean? The economy isn't bad, so the stock market likely won't be either. If the market is okay and poll numbers stay steady, then when next year's election starts, the Republican Party's chances of winning will probably rise a bit. Yeah, that's basically the idea. So as we move from the end of this year into next year, you'll see Trump rolling out a lot of substantial proposals. In fact, I think he's already starting to lay the groundwork for the election with these 2 points. Regarding the timing for the Public Security Bureau, good night. It's now at 4%, holding steady. The terminal rate is 3.68%. The expected number of rate cuts by the market increased slightly today to about 0.75 times. Honestly, 0.75 is not even a full rate cut, so whether or not there will be a rate cut in December, I do not think anyone needs to worry too much. Just keep following the economic data, the official statements, and international events. The Fed officials will naturally make the right decision on December 11th. So for now, the ups and downs are still just fluctuations, and whether there will be a rate cut in December, we will just have to wait and see. As for the US dollar index, it dipped slightly by 0.02% today, still fluctuating downward between the 200-day moving average and the monthly moving average. The overall trend of moving up and down has not changed much. As for geopolitical risks, regarding Ukraine, we just talked about this with everyone yesterday. Didn't the US propose that 28-point peace plan? We went through a lot of key points about the peace plan, discussing which aspects were involved. Actually, when it comes to the peace plan, we mentioned that there are many factors to consider. There are still some points that need to be negotiated, and it's not something Ukraine can just accept. For example, things like ceding territory for peace, not joining NATO, or reducing the scale of its military. There are a lot of issues like that. Right. What about Ukraine today? They just said this 28-point peace plan doesn't exist. They rejected it immediately. Yesterday it was Trump, and now they're working on a new 19-point plan. So from 28 points, it's down to 19, meaning 9 are gone. The main issues like territory are left for the presidents of Ukraine and Russia to discuss. Ukraine also said they're talking with Trump. They've been negotiating continuously, and the talks have been going pretty well. But as for what exactly is going well, they haven't really said. Ukraine also hasn't specifically explained what this new 19-point plan includes. They haven't really finished talking about it. So I think both sides are still in discussions and haven't fully made things public yet. So the clear situation is that after the 28 points, now it's down to 19. And how many points it will become next, nobody knows. Maybe it'll turn into some key peace points or just 9 points for peace, nobody knows. Anyway, in the end, they'll just keep negotiating. I don't think it'll be over that quickly, not just yet. But since they're still talking, of course, the geopolitical risks keep cooling off. The price of New York crude oil is still trending downward, still relatively weak. Today, it dropped another 0.46%. All right, at 9:30, besides sharing economic data, we still have some time. It's about 23 minutes past now, so there's still a bit before 9:30. When it's time, we'll update everyone on economic data. Tomorrow, things like durable goods orders, attendance rate, and PMI will be released. Just a reminder for everyone about Thursday. This Thursday, because of Thanksgiving in the US, the all-English program will be paused for a day. Now, why is Thanksgiving especially important? As we mentioned earlier, besides the very important retail sales data at 9:30 in the evening, there's another reason. Every year after Thanksgiving, for example, this year Thanksgiving falls on November 27th, right? The Friday after Thanksgiving, what does that mean? It means Black Friday shopping season officially kicks off. So for instance, this year, November 27th is Thanksgiving and the 28th happens to be a Friday. So that Friday marks the start of the Black Friday shopping frenzy in the US. Now, why is this important? This is called Black Friday, or the Black Shopping Festival. Like I just mentioned, every year after Thanksgiving, Friday is when everyone starts shopping in a hurry, getting ready. Getting ready for what? Getting ready for all the related discounts that start coming out. Once those deals are out, it leads up to the busy Christmas shopping season about a month later. So there's almost a full month between Black Friday and Christmas on December 25th. And every year, the most important shopping season for the retail industry, the time when business is at its peak and the best deals are available, is right now. The first is Black Friday, which is the Friday after Thanksgiving. And then what comes next? The day before Christmas. Why is it such a big deal? And then, of course, there's Christmas. These few days, these 3 days, are all extremely important peak shopping periods. They have a huge impact on retail sales, the economy, revenue, and all kinds of data, even GDP. So let me briefly explain why this is the case. Do you know why it's called Black Friday? Why is it called black? Well, in accounting reports, whether in the US or other countries, whenever you see black ink in the financial statements, it means a positive number. If you see red ink, what does that mean? It means a loss, a deficit, or being in the red. So why don't they use red? Why isn't the Friday shopping festival called Green Friday or Blue Friday? Why do they use black? It's because in financial statements, black means making a profit. So many of these retailers, as the year draws to a close, hope to use the so-called Black Friday shopping season and even Christmas or Christmas Eve to quickly boost their revenue. Maybe their performance in the first half of the year wasn't great, but at least after Thanksgiving, they can try to make a final push during this last month of the peak sales season. If they succeed, maybe they can turn a deficit into a surplus. That's why this retail event is called Black Friday. It's the origin of the name. Whether you call it Black Friday or Black Shopping Festival, it's the same thing. So just so everyone understands, black doesn't necessarily mean something bad. In this context, black is just a term used in financial statements. Of course, some American retailers, because they're worried that Black Friday sounds kind of unlucky, like Friday the 13th or something with a bad vibe. So when some retailers run promotions, what do they say? They call it Green Friday. They don't say black, they say green. Why do they call it Green Friday? Because US dollars are green. American bills, US dollars are green. So why do they call it Green Friday? It's all about making money, lots and lots of cash coming in. So that's just a quick fun fact for everyone. I think after the 27th, then comes the 28th. The retail sales industry's busy season starts then, having a big impact on US GDP and revenue. The influence is significant. For example, Walmart, Best Buy, and other department stores are involved. There are many. Ukraine has not confirmed a peace agreement yet. Negotiations are ongoing, but progress looks good. Let me answer a question from Peter Liu. Good evening, everyone. Hope you all had a good time. Black Friday, we talked about it yesterday. Costco had some deals and some people lined up. I saw a comment from a student saying someone lined up but still didn't get what they wanted. Maybe some deals hadn't started yet. That's how it goes. The Black Friday shopping season usually doesn't just last a day or two. Typically in Taiwan, it goes on for about a week or so. Costco and all those places have deals. And there are even some, like, remember how people were talking about Alibaba's Double 11 shopping festival? After Double 11, then comes this American Black Friday shopping season. So you'll see a lot of e-commerce platforms running all kinds of promotions. So it usually runs from Thanksgiving to Black Friday and sometimes even all the way to Christmas. Basically, there are all kinds of reasons for promotions. Usually these promotions, in my opinion, tend to last until the end of the year. And now a lot of department stores are also holding anniversary sales. Starting from Double 11, department stores in different countries have anniversary sales, then Black Friday, Christmas sales, and finally, at the end of the year, December 31st, there's New Year's Eve. What happens then? Everyone celebrates the new year, celebrates 2026, and there are all kinds of gift exchanges. So this whole sales boom will keep going all the way until December 31st, crossing into January 1st. And then after January 1st, what happens next year? We're talking about after the start of the new year. On January 1st, what do people do? Gradually, especially in Chinese communities, what do we start preparing for? Lunar New Year. The Lunar New Year brings another wave of shopping and festive atmosphere. Of course, the shopping for Lunar New Year is more closely related to Chinese people and Taiwan's stock market, but as for the US, it's becoming less and less relevant. In the US, the peak season usually falls in Q4, basically before December 31st. During this period, from Thanksgiving to December 31st, it's especially busy here, and the push to boost sales is really strong. So a lot of companies are going all out to drive sales, basically from November 1st all the way to the end of the year. That's right, it's just non-stop shopping all the way through. So you need to make sure you have enough money ready. And it just so happens that at this time is also really great, you know? What's it called again? Sensem, this thing. 2052 at night, huh? And right around this time, what happens at the end of the year? Besides getting your regular monthly salary, you also get your year-end bonus, or maybe a performance bonus. Usually, a lot of companies will give out a lump sum at the end of the year, or sometimes right before the Lunar New Year, so you suddenly have some extra money coming in. Naturally, people start thinking about buying new clothes, getting a new hat, shopping for all sorts of things, and even buying new furniture. It just keeps going, buzzing along from November through to the Lunar New Year, slowly and steadily shopping. For nearly 2 to 3 months, it's non-stop spending. And when the New Year comes, you still have to prepare red envelopes for kids and elders. The pressure keeps building. You start buying from November 1st, and after all that shopping, you still need to get red envelopes ready. This is actually a huge project that boosts the GDP of the US or Taiwan, but anyway, just keep an eye on the fun data. In any case, that's the whole picture, and remember that old saying. If the market is good and prices are going up as expected, remember to sell gradually along the way. Sell when prices are high and remember to buy back when they dip. Look for good stocks. Only by selling can you have more money to buy and trade back and forth. Right now, making short-term trades for price differences is still a relatively safe approach. Unless you bought stocks at a low point back in April or May this year, if that's the case and you've held through a rally and your long-term investment cost is still very low, then it doesn't really matter. But if you just entered the market recently, you need to be a bit more cautious. Even though there are these peak season trends and some promotional sales might help boost revenue and profits, you have to remember that the stock market right now is still at a high point, so buying and selling alternately is a safer strategy right now. All right, let's check the time. It's about 9:30. I'll see if the economic data is out, then talk about the international situation and some industry reports. Okay, it's out. The September 2020 retail sales month-on-month data has been released. September was about 2 months ago, but it's still worth referencing. So the data is 0.2%, right? That's below both the forecast and the previous value. The expected value was 0.4% and the previous was 0.6%. Let me check if the data's out. Oh, yes, it's out now. Now, regarding the PPI, the Producer Price Index, the monthly PPI just now surged to 0.3%, which is in line with expectations. The annual rate is 2.7%, also in line with expectations, but both are higher than last month's figures. This data is for September. Just to clarify for everyone, it's not for November, it's September's data, okay? Also, the core PPI monthly rate came in at 0.1%. That's lower than expected. The core PPI annual rate is 2.6%, also below expectations and lower than the previous figure. So overall, it looks like, aside from the monthly retail sales rate underperforming both expectations and the previous value, which suggests that retail sales are still a bit weak and cooling off a little, everything else is as expected. After all, people are still worried about things like the trade war and so on, so maybe everyone is just, well, if the trade war keeps going, prices will go up and then consumer spending will decrease, so retail sales will naturally decline as well. So this data actually reflects the atmosphere back in early September. It shows how the whole tariff issue was affecting the economy, impacting consumer behavior, and influencing the market. So at least back in September, that situation was pretty reasonable. The 0.2% figure for September was lower than before, but I want to remind everyone that this data is from September. For the future, including October and November, the real impact on the overall market will be more direct and more grounded. So even though retail sales were lower than expected, I can treat this as a neutral signal in the short term. It will have an impact, but as for the extent of that impact, I think right now it's not very significant. Another important point is the monthly and yearly rates for the PPI. Looking at it just now, most of the monthly and yearly rates either met expectations or, like the core PPI monthly and yearly rates, some of them were not only below expectations, but even lower than the previous values. For example, the core PPI annual rate came in at 2.6%, which is below expectations and also lower than before. This indicates that inflation is not out of control, so inflation hasn't spiraled out of control. Since inflation hasn't surged and the Producer Price Index hasn't spiked significantly, what does that mean? It means that the economic data the Federal Reserve is watching, especially regarding inflation, also isn't showing signs of being out of control. If inflation isn't out of control, then of course this is a positive factor for the Fed when it comes to considering rate cuts. This is also a positive for the stock market. So just to add, these are both September data points. The September data on retail sales and the PPI are provided here for your reference. Overall, I think the impact on the US stock market is relatively positive, just a bit on the favorable side. At the very least, inflation isn't out of control. At least, inflation isn't out of control. All right, that was an update on the fund data and a supplement to the economic data released at 9:30. Now, regarding financials, I want to mention whether the profits of the Magnificent Seven have peaked. Well, as for the Magnificent Seven, their profits haven't bottomed out yet. They're still in a growth phase and continue to grow. It's just that within the group, some companies are growing more while others are growing less. That's basically the difference. So what does it look like right now? The Magnificent Seven's profits in the third quarter are currently showing year-over-year growth of 18.4%. Although that's the lowest since the first quarter of 2023, you might ask, teacher, if it's the lowest since then, does that mean the economy is bad? Not necessarily, because the main reason for this is the impact from Meta. As for the Magnificent Seven, everyone knows the mnemonic Gu Yaping Dalian Teluan Ho. When we talk about these 7 companies, sometimes during lectures, we often share with everyone how to remember this mnemonic. Among the giants, their annual growth, although only 18.4% in the third quarter, which seems low, is actually due to the impact of Facebook, or Meta. Don't forget about Meta. At the end of October, specifically on October 29th, they released their financial report. Because they recorded a one-time income tax expense of nearly $16 billion, this tax expense, after being accounted for, caused their EPS to drop significantly and also made the results fall short of market expectations. So this situation also makes Meta, among the Magnificent Seven, become, well, let's just say it's not exactly the bad apple, it's not that bad. At least it has become the one dragging down the group, causing the Magnificent Seven to be pulled down overall. So if you take out the impact of Meta's $16 billion expense, if you exclude Meta, in fact, the other 6 giants in the Magnificent Seven have an average annual growth rate of 30.4%. The other 493 companies in the S&P 500 have also seen nearly 12% annual profit growth. So this means that aside from the Magnificent Seven, the other companies are also growing. Since they're growing, it shows that the economy isn't heading toward a so-called hard landing, so there's no need for everyone to worry too much. In addition, the S&P 500 constituent stocks are actually releasing their third quarter earnings reports one after another these days. 90% of the earnings reports have already been released, and among them, whether it's big companies, small companies, or any kind of company, basically everyone, 83% of these third quarter earnings reports have exceeded expectations. In fact, some investment institutions are even predicting that for the next 4 quarters, the Magnificent Seven's profits will continue to grow annually by 19% to 25%. So overall, I think the Magnificent Seven's revenue and profits are still pretty good and continue to grow. Of course, some are higher, some are lower. Stock prices vary, with some performing weaker and others still above the monthly moving average. What does this depend on? It depends on factors like the themes driving each company, technical corrections, or concerns about AI. So right now, the market is showing a more segmented, differentiated trend. Since this divergence means the market is currently leaning toward a more volatile trend, everyone needs to pay extra close attention to how they manage their holdings. Besides sharing this information with you all, there's something else I'd like to add. There's a company that just recently got a bit of a boost from the AI trend again, and it really hit the mark. It's called Broadcom. If you noticed, Broadcom's stock price surged about 11.1% yesterday. Currently, Broadcom is still holding above its monthly and quarterly moving averages. Let me give you a bit more background on Broadcom. Back around mid-October, specifically on October 13th, they announced a partnership with OpenAI to work on AI chips. These are specialized chips. The plan is for these to actually be operational by the end of 2029. So aside from Broadcom's collaboration with OpenAI, why did Broadcom surge so much yesterday? Who else did they get involved with? They got a piece of Google. But that's thanks to Google Spotlight, because on November 18th, Google, remember last week they announced the Gemini 3rd generation AI model? Well, the market's response and performance have been pretty good, actually quite impressive. Even OpenAI CEO Altman seemed a bit concerned, as if now it seems like Google's catching up fast, which could impact OpenAI's future market share. So Altman has also expressed some concerns and worries about this. Of course, if Google performs well and the 3rd generation does a good job, but why is this really related to Broadcom? Because Google, let's take a closer look at Google. In fact, Google has been working with Broadcom since 2016 on so-called ASIC chips. ASIC stands for Application-Specific Integrated Circuit. So what is this exactly? Let me give you a simple example. We've talked before about the story of Jingawashi and Jufen, right? NVIDIA's chips are what we call general purpose chips, meaning you can mine anything with them. Coal, gold, copper, whatever. They're basically like electric drills. That's why NVIDIA's chips are so useful. Whatever you want to do, whatever product you want to make, whatever you want to mine, you need an electric drill like NVIDIA's chip. But they're not cheap. Now, if you look at companies like Broadcom or Marvell, they make what's called application-specific chips. If you think about the mining sites in Jingguashi or Rifeng, you can imagine their tools as maybe a shovel or a pickaxe. What are they for? They're specifically designed just for mining coal or just for mining gold or for mining copper. They're made individually for specific needs. So ASIC chips aren't like NVIDIA's general purpose chips are like power drills. They're a kind of all-purpose tool. Those specialized tools have their own markets, and NVIDIA's general purpose chips also have their own much larger market. I basically think these two areas won't really conflict with each other. They won't clash, but each will have its own glory for hundreds of years. That's the idea. Now, as for Google, since 2016, they've been working with Broadcom on these so-called SQL chips. So what do these chips do? Well, Google has been developing its own AI chips, right? Like the TPU chips. These chips are currently being used in Gemini 3, whether in announcements or applications, and so far, things seem to be going pretty well. In fact, why did you all see that before the US stock market opened today? NVIDIA dropped sharply. Why did it fall by 4%? Why did it drop by 4%? It's because there were rumors, just rumors, that Google's self-developed AI chip, the TPU, was being considered by Meta. Meta wants to buy it. Right now, all of Meta's AI infrastructure is built on NVIDIA. They've always been using NVIDIA's chips, 100% buying NVIDIA's chips. But now it's rumored that maybe about 10 to 30% of their purchases might shift to Google's chips. Of course, this is a plus for Google. That's why if you look at the pre-market movement in the US stock market today, Google is still rising, up 3 to 4%, while Nvidia dropped 4%. This is due to rumors, so keep that in mind. Besides Google, Broadcom is also up, as I mentioned, because the two companies are working together. What about the S-chip? Back then, who developed and made Google's S-chip? Broadcom. As Google kept rising, Broadcom followed. That's why Broadcom stock also surged yesterday. Google rose 6%, Broadcom jumped 11%. That's the reason, the driving force, this news. Now, Broadcom is still strong, and for Google, it's basically staying above its 20-day moving average. Among the Magnificent Seven, it's performing the best. Yeah, everyone knows that. Right now, there are two major camps. Previously, the ones that surged the most were in the Nvidia camp. There are a lot in the Nvidia camp. Nvidia itself, Meta, then Amazon, Microsoft, and so on. A lot of these companies are buying Nvidia's chips, but now it feels like Google is slowly starting to make some moves in the AI chip space. There's a bit of improvement, or you could say they're starting to carve out a place for themselves. So this will turn into a situation where Nvidia's camp and Google's camp are compared. Who's stronger, who's weaker, who's more dominant. When Nvidia's side is a bit weaker, in basic chips, companies like Broadcom and Google could see faster growth. Will one side always be stronger? Not necessarily. It's about competition and cooperation. Watch Broadcom and Google. In the short term, they remain strong. Since I just mentioned that some are cooperating while others are competing, this really marks the beginning of the so-called warring states era in AI, where alliances and partnerships are forming. In the past, Nvidia was the dominant force. Nvidia was king, and everyone had to buy Nvidia chips. But now we're seeing that Google and Broadcom have important chips making rapid progress. Also, many companies that used to only buy Nvidia chips are starting to think maybe Google's chips aren't bad, or maybe Broadcom can design something for us. Companies like Meta, Amazon, Tesla, and others might not always just buy whatever Nvidia makes. So while Nvidia used to dominate the market, that's not necessarily true anymore. Why do I say there will be alliances and shifting partnerships? It's because companies that used to be your competitors, now, those competitors might actually become your friends. For example, here's a recent news story from last week. Why mention it today? Because it relates to alliances and partnerships, especially with the big jumps in Google and Broadcom stock prices yesterday and today. Many companies are quietly forming these alliances. Take Microsoft. Microsoft and Nvidia have an interesting relationship. On November 18, just last week, Microsoft said it would invest $5 billion in Anthropic. Nvidia also plans to invest $1 billion. After these investments, what does Anthropic do? Anthropic must invest $3 billion. Where? All of this is in US dollars. What is the purpose of investing $30 billion in Microsoft's cloud services? It's for making investments. In addition, they also need to rent servers equipped with Nvidia chips. Furthermore, this AI model is, for the first time, being made available to enterprises on Microsoft's cloud platform. So you find it quite interesting, right? In the past, who was Microsoft's biggest investment? It was OpenAI. Previously, Microsoft invested as much as $13 billion in OpenAI, which is a huge amount. And then, didn't OpenAI go through a corporate restructuring? So at least Microsoft still holds a 27% stake, which is quite interesting. Why is it interesting? Logically, Microsoft should be fully supporting OpenAI, and OpenAI's AI models should be fully supporting Microsoft, and the two should be working closely together. But after the restructuring, there's no longer any binding force between them. OpenAI can now collaborate with companies other than Microsoft. As for Microsoft, it's also no longer limited to just using OpenAI's ChatGPT. They can collaborate with other companies as well. So the relationship has shifted to a more expansive model of both competition and cooperation, becoming even more expansive. Now, in the short term, you won't see results very quickly, but over the long term, you have to remember one thing. When Microsoft, as well as those making chips and companies in various fields like CSPs or cloud providers, start to collaborate not only with OpenAI, but also with others. In fact, this puts a lot of pressure on Altman. OpenAI and Nvidia used to dominate, right? In the past, in the AI field, OpenAI was the strongest. In the chip sector, Nvidia was the leader. But now, if there's gradually more open collaboration and competition, or even possible alliances, then under this kind of structure, a lot of companies might not just want to buy Nvidia chips, and they might not only want to work with OpenAI either. Okay, so former friends and former rivals will all end up working together, joining forces. This actually benefits the overall growth and vitality of the industry. It really does have an effect. When it comes to company revenue and profits, I think changes will gradually appear. You can't see it yet, but slowly there will be subtle shifts. Right now, Nvidia remains strong. Many are buying their chips. OpenAI is also still in high demand. This platform is number one. But gradually, with more competition and collaboration, you have to keep this in mind. In the future, as competition and cooperation increase, this big pie will become more and more common, and the market will get even bigger. However, it will slowly shift away from being dominated by just one company. Many companies may gradually get a share of the pie, and those that do will see profits increase. Companies whose share is split off may see profits decrease. This is something we can expect in the future. This situation is foreseeable, but for now, in the short term, it hasn't happened yet. Just keep this in mind for now. All right, this company is also pretty interesting. Anthropic, for example, Amazon has actually invested $8 billion and Google has put in $2 billion. So it's really, really interesting because it collaborates with many of its competitors, friends, and even rivals. Some of the companies it works with are competitors, some are friends, so there are a lot of them. So you should know that whether it's OpenAI or even Gemini in the future, they might end up collaborating with many, many companies. The pie is just getting bigger and bigger. So how will revenue and profits change? We'll keep observing this in the future. Now, as for Microsoft, you should be a bit cautious. Fundamentally, Microsoft doesn't really have any major issues, but in terms of its stock's technicals, you should pay a little more attention. The blue neckline here has already been broken. Among the Magnificent Seven, I think Microsoft is the second relatively weaker company, aside from Meta, which is the weakest. Its stock price has already corrected down to the annual line, the 200-day moving average. Of course, when it comes down to the annual line, it's normal for the technicals to consolidate a bit and find some support. So yes, the 200-day moving average does provide support. So if you don't have, sell your shares, you don't need to panic or make drastic moves because the 200-day moving average from a technical perspective is a fundamental support. The real question is whether Microsoft can keep climbing in the future. As for the blue neckline in the chart, it previously managed to hold above it. Previously, being able to hold above the blue neckline was quite helpful for it. If the price still can't break above this blue neckline for a while and the current monthly moving average is still trending downward, curving down, then you need to pay a bit more attention. After all, Microsoft carries a lot of weight among the Magnificent Seven stocks. But its weighting also has a significant impact on the index, so it's better to be a bit cautious. You can treat the 260-day moving average as short-term support. Also, regarding the US stock market pre-market session, well, in the pre-market, Supermicro computers surged by 13.4% because of positive earnings results. There are other strong performers with solid fundamentals like Google. In US pre-market, Google rose 4%, Broadcom was up 2.62%, Applied Materials, Albemarle, and Intel gained about 1.7 to 2%. As for companies that declined, as mentioned earlier, Nvidia dropped due to rumors Meta might use Google's chips, replacing some of Nvidia's chips. So for Nvidia, in the US pre-market, it dropped by 4%. AMD, Advanced Micro Devices, also fell by 3.75%. So these two companies, which originally dominated the AI chip and AI GPU market, were the main ones affected. It seems like Google wants to take a slice of the pie from them, just a little bit. Estee Lauder also dropped 2.77% in the US pre-market. Micron Technology, Oracle, Dell, and SNC all fell by about 2% before the market opened. So you can see that today's ups and downs in the stock market are basically divided into these groups. It's basically the Google camp versus the Nvidia and AMD camp, that kind of idea. The Nvidia and AMD camp took a bigger hit today, so their stock prices dropped more. But as for the Google camp, they performed relatively better today. Let's look at how things performed in the US stock market for your reference. For the Dow Jones Index, as mentioned, it's still below the monthly and quarterly moving averages. But breaking below the quarterly average doesn't mean it plunged right away. It's not that bad. Instead, it's been fluctuating and consolidating around the quarterly line, which technically suggests it's more of a correction after a strong rally. So when will it change? When it climbs back above the quarterly moving average, that's when the overall market sentiment will really get a boost. But for now, I still think it's more of a sideways consolidation. As for the Philadelphia Semiconductor Index, it went up 4.63% yesterday. However, the 20-day moving average has started to turn downward, so it's better to keep an eye on it and continue observing for now. I think right now, it's still more of a pullback after a big rally. Even though there was a big drop one day and then a sudden big jump 2 days later, lots of ups and downs. Maybe today, with most of the related AI concept stocks falling, the Philadelphia Semiconductor Index is still under a lot of pressure. If the Philadelphia Semiconductor Index or the NASDAQ is under a lot of pressure and the 50-day moving average just can't be reclaimed, that's still going to be a negative for its performance going forward. So I'll be watching this current pullback after the rally. I don't think it's going to end that quickly. It's not going to end that quickly. So should you use the rebound in weak stocks to reduce your positions and stick with the strong ones? If there's a pullback, remember to look for good companies and good entry point for your positions. But right now, it's really a phase of keeping the strong and letting go of the weak. So everyone should seize the opportunity. Millie and Q Tongyi did well yesterday, getting back above the quarterly moving average. But today, will it fluctuate again and lose the average after just regaining it? No one knows, so keep an eye on it. The current regional investment remains an important confidence indicator. Treat the 50-day moving average as a key line between bullish and bearish trends. It's a key battleground, and this applies to individual stocks too. Yes, all the stocks you hold. You can simply make a comparison. If your stock is above the 50-day moving average, that means it's still a strong stock and doing pretty well, so you can keep holding it for now. But if the stocks you're watching have both the 20-day and 50-day moving averages sloping downward, or even some companies have dropped all the way to the yearly moving average, that means they're still relatively weak. For example, in the A-shares market, stocks like Oracle, Meta, or Microsoft might be relatively weak in the short term, and the short-term trend is bearish. The short-term trend is bearish, but if after consolidating the price can hold above the 200-day moving average or the quarterly moving average, then maybe after some consolidation with the boost from next year's midterm elections and the ruling party introducing some favorable economic policies, if the stock price can hold between 200 and 260, there's still a chance for it to perform well. All right, that's all for tonight's group session. We covered a lot today, including a lot of fun data and various topics. If you didn't catch everything, make sure to listen to the replay a few times. If you have any investment questions, feel free to leave me a message. If I didn't get to answer your questions today, I'll address it one by one in tomorrow's class. And as a reminder, after class, don't forget to like, subscribe, and share for us. Finally, I wish everyone smooth trading, and I'll see you all tomorrow.
Our company has no improper financial interests in the individual securities recommended or analyzed. The information in this program is for reference only. Investors should make independent judgments, evaluate carefully, and bear their own investment risks. If you don't want to miss the latest market updates, be sure to turn on the notification bell and hit subscribe. In addition, we have plenty of great video content on both Facebook and YouTube. Don't miss out. In our group, we share in-depth explanations of global financial events with you every day.